Before this video goes any further, a precise definition, because this claim is easy to misunderstand. Rich, in this video, means something specific, a level of wealth in the tens of millions of dollars or more, achieved primarily through one's own efforts within a working lifetime, not comfortable, not financially secure, not able to retire well. Those outcomes are absolutely achievable on a salary, and this channel has covered exactly how, repeatedly. This video is about something different. Why a 9-to-5 salary, no matter how high it climbs, has a mathematical ceiling that almost never reaches genuine wealth, while ownership, equity, and business income have no such ceiling. Here is the proof in one number. The highest-paid non-executive salaried employees in Canada, senior surgeons, top-tier corporate lawyers, the most senior engineering and finance professionals at large firms, top out at approximately $300,000 to $500,000 per year in total compensation in genuinely exceptional cases. Even at that level, after Canadian taxes, which reach a combined federal-provincial marginal rate of approximately 50% to 54% in most provinces above roughly $250,000, the after-tax income is approximately $150,000 to $250,000 per year. Compounded and invested perfectly for an entire 35-year career, that produces a very comfortable multi-million-dollar retirement. It does not, except in the rarest cases, produce tens of millions of dollars in wealth within a working lifetime. Compare that to ownership. A business owner, founder, or significant equity holder whose company or holdings grow in value has no such ceiling. Their income is not capped by an hourly rate or a salary band. It is capped only by the value of what they own, which can grow without limit. This video explains exactly why that structural difference exists, and what it actually means for how you should think about your own career and finances. Here is the foundational mechanism behind everything in this video. A salary is, structurally, a trade of your time for money. You have a fixed, finite amount of time, 24 hours in a day, roughly 2,000 to 2,500 working hours in a year for a typical full-time professional. Your employer pays you a rate for that time, whether expressed as an annual salary, an hourly wage, or a daily rate. This relationship is linear. Your income can only grow through one of two mechanisms: working more hours, which is bounded, there are only so many hours in a day, and diminishing returns and burnout set in quickly, or increasing your rate per hour, which is bounded by what employers are willing and able to pay for any given role, function, and market. Even the highest-paid salaried professionals in the world are still fundamentally trading hours for dollars. They have simply negotiated an extremely high rate per hour. A top corporate lawyer billing $800 to $1,200 per hour is still capped by the number of hours in a year they can physically and sustainably bill. There are roughly 8,760 hours in a year. Even working an extreme, unsustainable 80-hour week every week, that lawyer caps out around 4,160 billable hours. And most of those hours will not be billed at the top rate because administrative work, business development, and non-billable obligations consume a significant portion. The mathematical ceiling this creates: if your income is rate times hours, and both rate and hours have practical upper bounds, rate bounded by what any employer will pay for that specific role, and hours bounded by the literal number of hours in a year and human physical limits, then your total income has a calculable ceiling. For the vast majority of Canadian salaried roles, even in high-paying fields like medicine, law, engineering, and finance, that ceiling sits in the range covered in the hook: $300,000 to $500,000 in truly exceptional cases, with the overwhelming majority of Canadian salaried professionals, even highly successful ones, earning considerably less, in the $80,000 to $180,000 range across a career. What changes the equation entirely? Ownership breaks the rate times hours formula completely. An equity stake, a business, or an investment portfolio does not get paid for hours worked. It gets paid for value created or value compounded. And value has no inherent ceiling tied to the number of hours in a day. A company can serve 1 million customers as easily, in terms of the owner's personal hours, as it can serve 100. Software, automation, and scaled operations decouple revenue generation from the owner's personal hours almost entirely once the business reaches a certain stage. A stock portfolio can compound a $500,000 balance the same number of hours per week, zero in terms of active hours required, as a $50,000 balance. This is the structural reason a 9-to-5 has a ceiling that ownership does not. A salary is rented out hour by hour, while ownership compounds independent of hours entirely. Your action step. Calculate your own current effective hourly rate. Annual after-tax income divided by actual hours worked, including unpaid overtime and commute. Then ask honestly, what would it take, within your current role and industry, to double that rate? For most Canadians, the honest answer reveals just how close to the practical ceiling they already are. Here is the vault from the opening. The single combined number that caps how rich a salary can realistically make a Canadian, no matter how high the salary itself climbs. It is not one number. It is the interaction of two: the practical salary ceiling covered in Segment 1 and Canada's progressive marginal tax structure, which becomes increasingly punishing at exactly the income levels where a salary might otherwise start to build serious wealth. Canada's marginal tax brackets at the top end, 2026, approximate combined federal plus provincial Ontario as an example. Income $100,000 to $150,000, approximately 43% to 46% marginal rate. Income $150,000 to $250,000, approximately 47% to 50% marginal rate. Income above $250,000, approximately 53% to 54% marginal rate, the combined top marginal rate in most provinces. What this means in practice: a Canadian earning $400,000 in salary does not take home anywhere close to $400,000. After the layered marginal brackets are applied, their effective overall tax rate lands around 42% to 45%, meaning their after-tax income is approximately $220,000 to $232,000. Critically, every additional dollar earned above approximately $250,000 is taxed at the top marginal rate of roughly 53% to 54%. This means that doubling an already high salary from $400,000 to $800,000 does not double the after-tax outcome. The additional $400,000 is taxed so heavily that the after-tax gain is only approximately $184,000 to $188,000 of that additional $400,000, not the full amount. The combined ceiling, visualized. Notice the pattern. As gross salary increases, the after-tax amount grows more slowly than the gross figure, because each additional dollar is taxed more heavily than the last. This is precisely how progressive taxation is designed to work. And it means the realistic after-tax ceiling for even an extraordinarily high Canadian salary tops out in the low to mid $200,000 to $300,000 per year, not in the millions. Contrast this with capital gains and dividend income from ownership. Capital gains in Canada are only 50% included in taxable income, meaning the effective tax rate on investment gains is roughly half of the equivalent salary tax rate at the same income level. Eligible Canadian dividends, as covered in this channel's dividend taxation video, can be taxed at effective rates well below salary income at comparable total income levels due to the dividend tax credit. This means that even at identical pre-tax income levels, a dollar earned through business ownership, capital gains, or eligible dividends is worth meaningfully more after tax than a dollar earned through salary, compounding the structural disadvantage of salaried income on top of the rate times hours ceiling from Segment 1. Your action step: calculate your own effective, not marginal, tax rate using your actual income and province. Compare that effective rate to the approximate 20% to 25% effective rate that an investor with primarily capital gains income at a similar total income level would pay. The gap illustrates the second structural disadvantage salaried income carries beyond the hours ceiling alone. It is important to be precise here, because the goal of this video is not to convince anyone that salaried work is worthless. It absolutely is not. Here is the honest range of outcomes a 9-to-5 income, invested with discipline, can realistically produce. Scenario A: a typical Canadian professional salary. Maximized investing discipline. A Canadian earning $85,000, close to the national average for full-time workers, who maximizes their TFSA every year and contributes meaningfully to an RRSP, investing in low-cost equity ETFs like XEQT, maintaining a 25% to 30% savings rate across a 35-year career. Realistic outcome at 65, approximately $2,200,000 to $2,800,000. This is a genuinely excellent outcome, placing this person in the top several percent of Canadian retirees by net worth, capable of a very comfortable retirement, full TFSA tax-free withdrawals, and significant financial freedom. Scenario B: an exceptional Canadian professional salary, $300,000 plus. Maximized investing discipline. Following the same disciplined investing approach, at a much higher income level, contributing the maximum to both TFSA and RRSP every year, plus additional non-registered investing. Realistic outcome at 65, approximately $6 million to $9 million. This is a remarkable outcome by almost any standard. Genuine financial independence with very significant means. Where this stops, even in the best case, even Scenario B, the exceptional salary, maximized for 35 years, produces an outcome in the high single-digit millions. It does not produce $50 million, $200 million, or the kind of wealth associated with names that appear on wealth rankings. The mathematical ceiling from segments 1 and 2 means that even a best-case salaried trajectory has a calculable finite endpoint that sits meaningfully below the threshold this video defined as rich in the opening. Why this still matters enormously, even with that ceiling. A $2.2 million to $9 million net worth, built entirely through disciplined salaried investing, represents genuine, life-changing financial security for the vast majority of people who achieve it. The argument of this video is not that this outcome is bad. It is that it has a structural ceiling, and understanding that ceiling honestly is more useful than either pretending it does not exist or being demoralized that a salary alone isn't enough. The honest comparison to ownership outcomes. A moderately successful Canadian small business, not a unicorn startup, not a public company, simply a profitable, well-run business with a few $1 million in annual revenue, that its owner builds over 15 to 20 years and eventually sells, can produce a single liquidity event in the range of several million to tens of millions of dollars, achieved on a timeline often considerably shorter than the 35-year salaried trajectory, and with no structural tax rate or hours ceiling capping the outcome the way salary has. This is not a claim that business ownership is easy, guaranteed, or risk-free. It carries substantially more risk, uncertainty, and variance than salaried employment, including the very real possibility of the business failing entirely and producing a worse outcome than steady salaried employment would have. But the mathematical ceiling that applies to salary simply does not apply to ownership in the same way. Your action step: calculate your own realistic scenario, A or B outcome, using your actual salary, savings rate, and years remaining until retirement. This is not a discouraging exercise. It is the honest baseline against which any decision to pursue additional ownership, equity, or business income should be measured. This is the most practically useful part of this video, because the realistic answer for most people is not, quit your job and start a company tomorrow. It is a deliberate bridge strategy that uses the security of salaried income to fund a gradual transition toward ownership, without taking on reckless risk. Strategy 1. Use the salary to build the safety net that makes risk-taking possible. Most people who never attempt any form of ownership do not avoid it because they lack ambition. They avoid it because the downside risk, losing their only source of income, is too severe given their financial position. A salaried income's first and most underrated job is to fund an emergency reserve and a baseline investment portfolio robust enough that a future entrepreneurial or equity-based risk becomes survivable rather than catastrophic. A practical target: 12 to 24 months of living expenses in accessible savings, plus a base investment portfolio that is not dependent on the outcome of any future business venture before taking on meaningful additional risk. Strategy 2. Negotiate for equity compensation where available. Many Canadian roles, particularly in technology, growth stage companies, and some professional services firms, offer equity compensation, stock options, restricted stock units, or profit sharing as part of total compensation. This is the single most direct way to convert salaried employment into a partial ownership stake, without leaving the relative security of an employment relationship. A Canadian software engineer with a $130,000 base salary plus meaningful equity compensation at a successful growth stage company has a fundamentally different ceiling than the same engineer at a company offering salary only, because the equity component is not subject to the rate times hours ceiling from Segment 1. Strategy 3. Build a side business while employed, using the salary as the runway. A significant proportion of successful Canadian small business owners and entrepreneurs began their venture while still employed full-time, using their salary to cover living expenses and fund the early, typically unprofitable stages of the business, before transitioning to it full-time once it demonstrated sufficient income to replace the salary. This approach dramatically reduces the personal financial risk of entrepreneurship compared to leaving a salaried role with no income and no validated business model. Strategy 4. Invest aggressively in equities, which is itself a form of fractional ownership. It is worth stating directly: buying shares of a company, even through a diversified ETF like XEQT, is a form of ownership. A Canadian who directs a significant, disciplined portion of their salary into equity ownership over decades is using their salaried income specifically to acquire an asset class, ownership of businesses, that does not carry the rate times hours ceiling. This is, in fact, the single most accessible and lowest risk version of converting salary into ownership available to virtually every Canadian. And the channel's prior videos on TFSA maximization and index investing cover exactly how to execute this specific strategy. Strategy 5. Develop scalable skills, not just billable ones. Skills that scale: content creation, software products, intellectual property, productized services, allow a salaried professional to build income streams that, even while modest initially, are not strictly bound to the rate times hours formula, in the same way a traditional employment role is. A side income stream built around a scalable skill, even one that only reaches $10,000 to $30,000 per year initially, represents the early stage of an asset that could, with time and reinvestment, grow well beyond what additional salaried hours could ever produce. The combined approach. Most Canadians who eventually build wealth beyond the salaried ceiling did not abandon their salary abruptly. They used it as a financial foundation, funding the safety net, the equity stake, the side business runway, or the equity investment portfolio that eventually allowed ownership-based income to either supplement or replace the original salaried income entirely. Your action step. Identify which of these 5 strategies is most realistically available to you in your current role and financial position. Commit to one concrete action on it within the next 30 days. Whether that is negotiating equity compensation, starting a side project, or increasing your equity investment contribution rate. Let's come back to where we started. A precise definition of rich: tens of millions of dollars or more within a working lifetime. Not comfortable, not financially secure, not a great retirement. Those are different, achievable outcomes that this channel has shown, repeatedly, are absolutely within reach through disciplined salaried investing. What is genuinely capped is the upper bound. A salary, no matter how high it climbs, is structurally bound by rate times hours, both of which have practical, real-world ceilings, and further compressed by Canada's progressive tax structure, which takes a larger share of every additional dollar at the income levels where serious wealth would otherwise start to build. The honest math: even an exceptional Canadian salary, invested with maximum discipline for an entire career, realistically produces somewhere between $2 million and $9 million by retirement. Genuinely life-changing. Genuinely secure. Not, in almost all cases, the kind of wealth this video specifically defined as rich. That ceiling exists because ownership, equity, a business, a portfolio of compounding capital, has no such structural limit. Value can scale independent of hours. Capital gains and dividends are taxed more favorably than salary. The mathematics simply work differently. The most useful response to this is not despair, and it is not quitting your job tomorrow. It is using the security of a salary deliberately, to fund the safety net, to negotiate equity where available, to build a side venture on a stable runway, and to invest a disciplined portion of every paycheck into ownership of real businesses through low-cost equity ETFs. A 9-to-5 will likely never make you rich, by the strict definition this video used. It can absolutely make you secure, comfortable, and free. And it can be the very foundation that eventually funds the ownership stake that does.